when the market does decide to give us something that is worth managing, profit managing, we want to make sure that we have every available tool at our disposal. So that's where volume profile comes in. Now, I'll give you a slight overview or a little overview of the strategy and what happens when profit does come our way, or the potential for profit comes our way. Because we're putting on these asymmetric risk to reward, in other words, again, very tiny little risks for large outsized rewards, that takes the strategy that we generally use is a very wide butterfly, an out-of-the-money butterfly. So if you know anything about the butterfly, it's kind of shaped like this, and then it has the wings. And because it's out of the money, unlike the way most people play it, they put it right at the money, or it's very similar to an iron condor, they put it at the money. That usually gives you a risk to reward that's quite different than what we have. Usually those type of strategies require a lot of upfront risk for a very tiny reward, and you're hoping that price stays within a certain range. Now, on a day like today, that would probably work out well, but you still have to put up a tremendous amount of capital for a tiny little bit of profit. And so when those days go off and price is moving, those type of strategies don't work very well at the money. So what we do is we put it way out of the money and we're trying to get a directional move. Now, in most cases, in choppy markets like what we have in volatile markets, we can't tell which way the market's going to move. Is it going to go up today? Is it going to go down today? Is the Fed positive or negative? It's hard to tell. So we take a market agnostic position and we'll put an out of the money butterfly above the market and an out of the money butterfly below the market. So both of them have very tiny risk. And if the market moves towards one of them, we have the potential of making a lot of money. Now, how much? Well, in most cases, we're taking anywhere from a 1 to 9 to 1 to 20 risk to reward. So there is the actual potential, if you're betting $100, to potentially make $2,000 or more. In fact, I did a trade a couple of weeks ago where I put up $200 and I returned $2,100, but I had the potential of making nearly $6,000. So now, will we get that 6,000? That's a long shot, but making something like $1,000 or $2,000 isn't such a long shot. And when that happens, we want to make sure that we're ready to take that kind of profit. So that's like the basis behind what we do. Tiny risk, large outsized reward, relatively low probability of winning, but low drawdown, so we're never really in trouble, and a nice steady equity curve. Once you get really practiced at this, it really is a fantastic way to trade because you're never really anxious. You're never really making panic decisions because there's no need to panic. And then when you are in the money, it's really a great feeling for the amount of money. Even the small wins in our strategy are still returning you 100, 200, or even 300% return. And then the big ones can return 500 or 1,000% return. So when profit does get in that way, we have a framework that we use where we divide up the day into segments, the early part of the day, the mid part of the day, and the latter part of the day. And the reason why we do that, because we're doing premium collection on the 0 DTE, the very last day of expiration, is that profit curve, that premium is decaying at an exponential rate throughout the day. And the amount of decay that it has is accelerating throughout the day. So it starts out slow and then starts gaining some speed and then is going at a breakneck pace at the end of the day. So what we do is we split up the day into 3 distinct segments. That's because at the beginning part of the day, we have a very wide latitude. The profit curve tends to be kind of flat. And then in the mid part of the day, it starts growing, kind of like a dog leg. And then at the end of the day, it's like falling off of a cliff. And so we want to maximize where we are, when we are, and where we are on that profit curve. Now, we don't have any control of where we're going to be, but we do have control over how we act at different points of the day and depending on where we are. So we create this framework that kind of splits up the day into those 3 spots, as well as take notice of where we are relative to the butterfly that we put on. Now, that gets us the basic framework and strategy, and then we have to figure out how do we know whether or not to take profit then, as opposed to waiting until the end of the day. Because if your profit is right inside the butterfly and you're near those short strikes, that would be the ideal situation. You want to have the confidence that, hey, I want to hold on right here and just wait for it to go all the way to the end of the day to receive the maximum amount of profit. Now, why would you want to do that? Well, when you start getting down to those final moments, it's 3 o'clock, then it's 3:15. And then 3:30, and then quarter of 4. The amount of decay that's happening and the amount of profit that you're potentially collecting starts increasing at a geometric rate. So you could be, say, 20 minutes before expiration and maybe have, let's say, $500 of profit that you could take right then and there and get out and feel really good after maybe putting up $150. That would be a great day. But you also know that if you just held on for another 5 or 10 or 15 minutes, that $500 could turn into $1,000 or $1,500 just by doing nothing, just sitting right there. So you want the confidence, or at least some kind of way of telling whether or not it makes sense to stay there or not. And a lot of it has to do with the momentum in that day, but a lot more of it has to do with the underlying market structure.